Can you hear me, Sue?
Yep.
Yes, we can
Okay.
hear you, Lewis.
Oh, hey, Bobby. How's everybody?
Hey. Okay.
Good.
Good, Lewis. How are you?
Fine, fine. How's everybody? Hey, Gwelda, how you doing, babe?
Good. Yourself?
Fine. You're looking well as usual.
Thank you.
Look like you've been tanning somewhere or something.
No. My natural color is the crown.
You haven't been to Jamaica, Martin?
No, I have not been south of the US. No, I have not.
But you are
Right.
further south of all of
I'm
us.
further south than everybody else.
We expect we expect you're getting the best weather of all of us. So
Go.
This meeting is being recorded.
Okay, so I mean,
We
we
got-
are live whenever we want to get started.
Got Sue?
I'm sorry?
We have enough. Do we have enough to
quorum?
start?
Yeah, we
Yeah.
have enough to get started, yes.
Okay. Where's Christina or Al or Martell? Are they there?
Yeah, Dr. Sanders is here.
You give us
Okay.
a chance. Give me a chance. I already know I'm starting the meeting. We're starting our investment. Welcome to our investment meeting today, February 16, 2023. The time now is 4:30. Can we get attendance, Sue?
Sure. Angela Banks, Christina Bennett, Lewis Cross,
Present.
Sheila Goodwin, Shanice Johnson, Donna Jones,
Here.
Yvette Levy, Martell Mann, Bobby Richardson,
Here.
Albert Sanders,
Present.
Doris Walker.
Here.
All right, so we do have 5, so we do have a quorum.
Okay.
So Jeff and Gwalda, I don't know where you want to get started, which one?
We'll get started on the performance report. I'm going to open up. Jeff's going to do the market review, and then I'll get into the meat of the fourth quarter report.
The quarterly report.
Mhm.
Gwelda,
Yes, yes, sir.
I have the Jaws music today. Are we gonna need it?
No. Not for my part.
no, I think what's the happy dance music? Do you have a happy dance music? Because I think that's when we get to play in the background today.
Okay, great.
Okay. If you'll turn to the next page, just want to go very, very briefly over a letter. Go back one page. Over a letter that our CEO wrote to the clients. The very first page after the cover page too. Want to say good evening to everybody and Happy New Year. I don't think I've seen some of you since last year. But Happy New Year, Happy Valentine's Day, and all of that. So first off, I'd like to say thank you for the opportunity to serve you as your investment consultant and the trust that you have shown in me, Jeff, and all of the ANCO staff. Couple things to note, the company continues to move along very well. We reinvest 100% of our profits back into the firm. We have added additional personnel in different areas. We've added additional technology, and we'll continue to improve and make sure that we have all the resources necessary to serve you as investment consultant to help you meet the needs and of the plan. With that being said, I'm going to turn it over to Jeff, and he's going to talk a little bit about the markets in the fourth quarter and last year to frame the discussion regarding your funds. You're on mute, Jeff.
All right, the mute button on there. I hope everyone can hear me. And good afternoon, everyone. Good to see everyone. And as Gwalda said, late Happy New Year to everybody. And getting back into the mix. I know we had a break there in January, but all has been well and good, at least if not bouncy from a market standpoint. Sue, can you back up a couple pages on the report here to our first page of the overview? No, go forward one here. One more. There, perfect. Great. So these are the markets as of the end of the quarter. You can see all the way at the top right. Those are the quarterly numbers for all of the markets. And then below, you can see still everything in the other direction for the full year. But the quarter did a real excellent job of starting to chip away at those negative numbers. So as you can see, the top set of bars, those are the U.S. equity indices, and S&P 500, those are those most liquid large cap stocks. And then down at the bottom of that section is the Russell 2000. And so all of those categories in the US were anywhere from 6% to nearly 10% positive. So that's a really good quarter. But that was it's sliced and diced in a little different ways. That October and November were really good, and then we gave some back in December, but ultimately the headline stories have really been the same, and it's been inflation. So if you think about the past year and those numbers you see for the 1 year numbers below, and why those have been not so great, it's been that elevated inflation number. So we started at a peak inflation of over 9% year over year, and that's really high relative to historically where inflation has been, and certainly relative to where the Federal Reserve wants that number to be. So they would like it to be in the 2 to 3% range, and that's more normal, what we'd say price growth over time. And when you're at levels that are 9% plus, and now we're at about 6.4%, so we've certainly come back in the right direction from some of the things that the Fed has done to fight that, but we're still high. And so that's really what the markets are most concerned about. So certainly the longer inflation stays high, it means it's harder for all of us to go out and buy things. They're just more expensive, and we don't want to buy as many things. But that's where I think that everyone's sort of scratched their heads, and the market's been really perplexed right now, is that despite how high a lot of prices have been, and depending on what you're looking at, whether it's a car or a house or just a television or something else out there, when prices are so high, you would think, well, people are going to stop spending. But for the most part, consumer spending has stayed pretty strong. So that's sort of the conundrum that the market has run into, and why we're continuing to see a lot of volatility of, how long can this last? And eventually, if the Federal Reserve continues to raise interest rates, it makes things more expensive. It makes it more expensive for us as consumers to borrow, because our credit card bills get higher. And if we have mortgages, it makes, and if we have a mortgage that floats over time, it makes that mortgage more expensive. And for new people coming into the market to buy a house, that makes their ability to buy that house and to borrow money to buy that house more expensive. So that's how it kind of impacts all of us at where we sit. And then for businesses, it's the same thing. They have to go out and borrow money. A lot of businesses use debt to finance whatever they do. And when interest rates are higher, that makes it more expensive. So that it's kind of it's a double-edged sword, in that when things are more expensive, it brings that inflation number in. So it ultimately makes things more affordable for us as we go forward and to grow the economy. But it also does the nasty thing of slowing down an economy and making businesses operate a little bit slower. And then ultimately what we really want to avoid is unemployment. So if businesses have to tighten their belts, then they stop hiring, and then they start laying people off, and that unemployment goes higher. Again, we haven't seen that. The employment numbers have been good, but again, these are the things that are telling the Fed, if we want to bring that inflation number in, we want to normalize things, then we still have to be aggressive on raising those interest rates. So that creates the volatility that we've seen. But when you see a good quarter like that, that we had in the fourth quarter, a lot of that's just is going to be the response of the Fed has raised rates. Most people think that we probably have the worst behind us. We're probably going to see more increases, but not to the extent we have over the past year. So we're starting to get towards the end of that cycle. So the market has a sigh of relief on that. And then in addition, everybody is watching the inflation numbers as they come out every month. And so again, as I said, we were at a peak of over 9%. Really high. As of the last reading, which actually was on Valentine's Day, so got a little Valentine's Day sort of a treat. The number came in a little bit. So the previous month it was about 6.5%. This month it was about 6.4. So it got a little bit better, but not as good as everybody wanted. So we still have some room that we need to get towards that 2 to 3% target. So that's what we're all keeping an eye on over the next couple of months and couple of quarters, just to see again, can the Fed raise rates to the extent that helps the inflation, but also doesn't push us into a recession and start to cause a lot of unemployment. So that's really what the market looks at as a gauge here. So again, we saw from January a little bit more of a positive tone than not, and we'll go over the flash report in a moment. But again, just a continuation of the theme going into January, that the expectation is that inflation number is going to keep coming down while the Fed is likely to still raise rates a few more times, but the level is not going to be extensive as it has been in the past, and we're probably getting a little bit closer to the end of that cycle. So again, a lot of that was positive news as we fed into January. In February so far, it's been a bit of an up and down. So it started off a bit strong. We were up a couple percent just based on some data, and now a different inflation report came out today and said, well, inflation hasn't come in as much as necessary, and so in a couple of the other Fed governors who are a little bit more on the aggressive side said, well, we want it to be a little bit more aggressive, and we might want to be more aggressive. So that's the sort of tone that's giving February a little choppiness. So we've given some back, and we're still a little bit positive in the equity markets for February, but the fixed income markets are not reacting as well, just because, again, if the Fed says we have to keep raising rates, that always tends to be a bigger impact on the fixed income markets. So those are the big ticket items. The other thing that really the other overhang that's out there that I'm sure everyone is reading about on a daily basis, and that's the debt ceiling, and the fact that we as a federal government we're sort of at our debt limit, and in order to get that raised, that's a process. And so we've got a couple of months. That I think that the due date on that's going to be sometime in June, but that's always a highly politicized process. So we've got a lot of politicians and Democrats versus Republicans and everybody in between that has their thoughts on it, and how we can get the debt ceiling raised, but there's going to be a lot of give and takes on that. So again, expect that to be very political, but I think ultimately, if we apologies, I need to turn my phone off here. Sorry about that. So ultimately, in a probability standpoint, there's two things to think about. Number one, and everybody talks about this, and this is what gets most politicized, is if we as a country have to default on our debt. So that's kind of the worst case. If we can't figure out a way to raise the debt ceiling, then we ultimately default. That's probably a lot more rare, and pretty much no matter where you sit politically on Capitol Hill, it just doesn't bode well for the country and how we look to the rest of the world if we have to default on our debt, and it means all sorts of things. So that's ultimately where things will get worked out, because we don't want that to happen. So that's sort of the lower probability. What tends to be a little bit more higher probability in this situation with the debt ceiling is government shutdowns. So and we have seen those in the past when these debt ceiling discussions have come up, and there have been shutdowns, and again, the more politically charged these things get, the more it goes in the direction of, okay, we are going to have to shut down the government for a couple of days, and again, those do have some short-term impacts, not only on the economy, but the markets don't react favorably to those things. But ultimately, that's where everybody has to come to the table and agree on a budget and make sure we have something that gets us forward to ultimately keep us away from that default scenario. So that's the other overhang, and that's the one that everyone looks at and says, if that starts to heat up and come into play more, that's another one of those factors that gets us closer to a recession. So lot of interesting stuff out there going on that we're all keeping an eye on. But I think at the end of the day, as we go through the portfolio and the structure, these are all things that, as we've talked about before, and we'll continue to emphasize in a structure, that this is why we diversify, and this is why we have all of the segments of the market covered that we have. So different styles of equity from US and international, and covering all of the different sectors, the financials, the technologies, and styles, capitalizations, why we have money in fixed income, why we have a very good diversified fixed income structure, and then also having these things that really are good diversifiers and try to protect us in these crazy equity and fixed income markets. And that's on the private side, the private equity and private debt in the real estate structure. So again, we continue to be confident in the structure that we have. And again, as we take a look at the numbers, we'll see how we look relative to benchmarks and peer rankings, and those numbers continue to be really good, and that's because we have a good structure here. So let's fast forward. That's about all I wanted to cover at a high level on the markets. But Sue, if you can flip forward, let's see, a couple pages. There's a couple of tables on equity market holdings right here. This is it. So this is what I want to talk about, because as well that we'll go through performance and talk about some of the managers and things that impacted managers. This page is always interesting because in some markets, if you take a look at how this reads, so we have the different indices on the left as the Russell 1000. So those are US large cap stocks. And then on the right, those are the Russell 2000. So those are the US smaller cap stocks. And then at the top blue box, those are the top 10 weighted holdings in each segment. So on the left, you'll see a lot of names that I think everybody knows, those big blue chip large cap names, the Apples, the Microsoft, the Amazons, the Russell 2000, those in the small cap. Some of those might not be as recognizable. These are all the smaller and up and coming companies, but you also see from the index and the weights on the left, some of those bigger names are more sizable positions within the overall economy and in an index. So you can see Apple at 5.5%, Microsoft just over 5%, and then to the left, all of the bigger names within that index they're small. There's a lot of them, and they're smaller. And again, they just make up indices differently. But what stands out even more, at least from this quarter, and we do see this occasionally, the next two boxes are the top 10 performing stocks, and then the bottom performing stocks. And some quarters you might see those numbers not be as big. They might be single digit positive numbers in the best performing category, or single digit negatives in the negative category. But here we see some pretty heady numbers. So if you look at the top 10 best performing stocks on the large cap, they're 50 to over 80%. Those are really big moves. And then on the downside of it, again, for large cap, you have some that are down 40, 50, 60, 70%. And then over on the small caps, again, those numbers are amplified even more. So look at the top performing stock in the Russell 2000 at over almost 350% for a quarter. That's just massive. And then if you look on the downside portion of those small caps, you have names that are down close to 100%. So the reason I point this out, and it'll make a little bit more sense when Gwilda talks about some of the managers, it's these types of individual stock moves and the magnitude of those moves in these types of market that can really be an issue for certain active managers that are trying to beat indices. And and again, we sort of saw when we talked about Intech and that large cap growth, that's an area where some managers are really having a challenge. And it's because if an Apple has a really big move, and if you're underweight Apple and Apple takes off, you miss the benchmark, or vice versa. If you try to keep your market weight in Apple and Apple has a really bad quarter, then you didn't do as well. So that's been a real challenge for some of those managers. And that's one of the reasons that we did recommend moving away from an Intech and temporarily, or maybe not temporarily, keeping that money in a large cap index, because that's just a more efficient structure. But, and again, as you'll see from the numbers of the portfolio, active managers in the small cap space that have been trying to beat the indices, they've actually by and large done a really good job because of some of these moves that you see. So a lot of these down 100% names are companies that your active managers have taken a look at and said, well, they're just they don't have a good balance sheet, or they don't have a good model, and with the potential for a recession coming, this is a business model that doesn't make a whole lot of sense. Let's avoid these types of names and let's be in some higher quality things and make sure we're well hedged in our portfolio. So that's again, the small cap managers have on an active basis have done a pretty good job in this type of market in navigating some of these real big swings that we're seeing in these stocks. So I'll pause there for questions, and if anybody sees a name on here or says, hey, that looks interesting, what's going on, certainly we know our managers are keeping on top of this. So questions? Okay. Well, good. Well, I'll turn it over to Gwelda, and she can kind of bring it home with the actual numbers, and which, as you see, they've been really good.
So move to page, I believe it's page 14. Let's see.
Okay.
Keep going. It's that page there. We'll stop there. Okay, this is a page where we typically talk about, so you can see how your fund is positioned compared to the targets that were established in your asset allocation policy. As you remember, the gray bar represents the range, upper and lower range, and the dark line in the center is the tactical target. As you can see here, all of the segments were within the range, with the exception of the total hedge fund allocation, which is slightly higher than where it should be as far as the ranges are concerned. With respect to different segments, the ones that are most out of whack are core fixed income, private debt, and real estate, being furthest away from their targets. We've addressed how we're going to get the private debt back into range, closer to its target range per the study that we just did in the pacing study. And we also talked about the real estate segment, we'll address later in the year when the valuations come in at the end of the year for all of your different real estate managers. We expect to we just and in core fixed income and domestic core fixed income, actually we just did a rebalancing with some of the money that came in from Grosvenor to core fixed income. So you should see that reflected in the February numbers, which we have in March. So that the core fixed income should come more towards its target in the month of February. Now, as you can see here, go to the next page, Sue. The market value for the fund, as you can see here, at the end of September, the market value for the fund was $753,659,926, and at the end of December, $806,957,220. So we saw an increase. We saw a increase in market value reflected in the returns you'll see in the next few pages. Page 16 and 17 are the next one I want to focus on. So can you increase that? Oh, there we go. Okay, as you can see, we do the fees once a year. As you can see here, we went over this last year. The two things I want to point out here is on the, or one thing is on the index fund, that Mellon Stock Index Fund. We reduced the fee down from the index fund on the core side from 8 basis points down to 3. That's part of the negotiation that was done with the bank. So we have brought down the fees in that area. TIPS fund was already at a low fee, but the other fees are within range. We did have a little bit high in the small mid cap area, but that's not unusual for a small mid cap manager to have a higher fee. But the rest of the fees all were in line. Page 18. So one more, sorry. One more page. You want to go to the broker page. Okay, you can scroll down just a little bit. On this page, want you to see what's really good is that just scroll up a little bit so they can see the whole page. Okay, what I want you to see here is that you can see here on the MWDBE commission, this far right column, with the exception of Intech, who has been terminated, all the managers are at the commission percentage in MWDBE for their respective segment or right on top of it. Most importantly, TCW, which we had concerns about. As you can see here, they have met their MWDBE goal for the amount of commissions that they actually generated. They obviously didn't trade a lot, but they're there. Systematic is just 1% below. Westfield is 1% below. But the other ones in international, as well as in fixed income, they've all met their commission goals in WDBE as prescribed in the investment policy document. So that's we've got that problem worked out. Go to page 20. This is the financial reconciliation. Go to the next page. The bottom of the next page is the total. As I mentioned at the beginning, the market value at the beginning of the fourth quarter was $753,659,926. You had contributions of $35,241,831. You had distributions of $26,706,430. Management fees that were booked in the fourth quarter of $45,639. You had a small other expense there. But what I want you to look at here is we actually had capital gains from the third quarter to the fourth quarter. With the decent performance of the fund in the fourth quarter, you see here a capital gain of $44,807,537 to end the year at $806,957,220. So we're making up some of the losses that we saw in 2022. Okay, go to page 25. Go to the next page. I'm sorry, I'm one behind. Okay, on this page, you show the fund rankings. What I'd like you to look what's key here. I remember a while back we were concerned about the rankings of the fund, the total fund, the composite. As you can see here for the fourth quarter, the fund actually had a return of 5.99 and ranked 44th in the peer group universe. The 1 year ranking, albeit negative, is above the median, ranking 20th. The 2 year is at 28th. The 3 years above median, 47th. The only 2 years rolling periods that we're showing below the median is in the 5 year and the 10 year. And since inception, the fund ranking has come up. So we're going to continue to work on getting the fund ranking up, but you're doing better than the average public fund of your size in most time periods measured. You can go to page 27. One more page, I'm sorry, Susan. Okay, this is the roll-up of our executive summary for the pension fund for the fourth quarter. As you can see here at the top, as I mentioned, the fund would return 5.99, which exceeded the policy index in the fourth quarter and ranked 44th. Over the 1-year time period, albeit negative on a relative basis, your active managers were able to add value over the passive policy index with a return of a negative 10.98 of the policy index. If you had been invested all passive, with a negative 12.12, and that earned a rank of 20th. If you look out over time, as I mentioned, the fund has exceeded the policy index in all time periods measured, and the rankings, as I mentioned, are only below the median in the 5 and the 10-year time period. As we go down the page, you can see here as far as the total equity return for the quarter, the composite return 12.04, and that's both the international and the domestic. As you can see here, the domestic equity segment really added value. The total equity composite is domestic composite 9.40, which ranked 45th above the Russell 3000, which represents large, mid, and small cap stocks domestically. So outdistanced that. On a relative basis, on a 1-year basis, the fund protected, the domestic equity manager protected against the Russell 3000, albeit negative at 16.97. But if you had been passive, it had been negative 19.21, and this was just slightly below median for the year. Now, if you roll down a little further, you'll see that large cap quarters are presented by a passive index. That's a very efficient part of the market. That's why that is indexed. But at the bottom of the page, in the large cap segment, we have Edgar Lomax, which is your large cap value manager. As you can see here, Edgar Lomax in the fourth quarter delivered a return of 15% versus 12.42 for the Russell 1000 Value Index. So they ranked 17th, which is significantly above the average manager that manages in that style in the fourth quarter. Over the past year, even though it was a very low positive number, it was a positive number and ranked 14th, a positive number of 0.04. If you've been invested in a passive value index, would have been a negative 7.54. So this active manager actually has added value in the past year in what was a tough equity market. On a longer term basis, they're a little bit more challenged as far as their peer group is concerned. But if you look at them versus the Russell 1000 value, the manager has added value over above the Russell 1000 value in the 3-year, 5-year, 10-year, and since inception time periods. Next page. Jeff talked a little bit about the growth area. Been a tough time for a lot of active large cap growth managers, because if you weren't heavily weighted in some of those larger allocations of stocks in the Russell 1000 growth, you underperform, as he mentioned earlier in his commentary. As you can see here in the large cap growth segment, the managers collectively returned 2.57, which was above the Russell 1000 growth 2.20. On a relative basis, on a fiscal year to date and 1-year basis, they are below the Russell 1000 growth. As you know, we did terminate Integ Broad Large Cap Growth Manager. This is the last quarter. Actually, you'll see their performance in the flashes you will see from Jeff. You will see their actual market value is significantly less. TCW is the large cap growth manager that was left. As you can see, albeit they did not rank well in the universe, they outperformed the Russell 1000 growth in the quarter, 2.99 versus 2.20. Over the past year, had difficulties, and a lot of this is due to where they were not weighted with respect to the index. In this particular quarter, though, the reason they outperformed the Russell 1000 growth was due to security selection in 3 sectors, primarily consumer discretionary, information technology, and financials. In addition, they are on watch, not only for performance, but also they announced it earlier that there is a portfolio manager that is retiring, Craig Blum, and Brandon Bond will be taking over. He's been with the firm for quite a bit of time, and I believe he was the one that came in and presented to you a few months ago. He will be taking over the management of this portfolio. So we'll continue to keep them on watch, not only for performance, but also to see if Brandon can continue like we're seeing this quarter to bring value to this portfolio. Going down the page, look at small, mid, and macro cap. As you can see here, this segment actually did well versus the Russell 2000 index, which represents small cap stocks. And you can see here the return of this segment was 8.99 versus 6.23 and ranked right at median. On the 1 year basis, protection on the downside, negative 15.47 versus the Russell 2000, negative 20.44. And if you look at the 3 year, 5 year, 10 year, and since inception numbers for this segment, they in most periods they have ranked above median, but in all periods it's above the Russell 2000 index. The first manager here is Westville, representing small cap growth. And as you can see here, they delivered outperformance of 4.54 versus 4.13 for the index. Over the past year, protected on the downside, negative 24.83 versus a negative 26.36, and ranked 34th. Long term, this manager has added value significantly above their market benchmark, albeit not as strong as some other small cap growth managers. Systematic is your small cap value manager. As you can see here, they added significant outperformance over the Russell 2000 value with a return in the fourth quarter of 11.90 versus 8.42 for the index, protected on the downside. And the 1 year time period, a negative 9.31 versus a negative 14.48 for the quarter. And for the 1 year, they're above median 41st and 40th. On a long-term basis, this manager has not only added value over and above the Russell 2000 value, but has ranked above the median in all time periods measured. Now, as you run down a little bit more in the capitalization area in the small mid-cap segment, we have a micro-cap manager, which is DFA. DFA did well in the fourth quarter, as you can see, with a return of 10.07 versus their benchmark at 6.23. Protected in a typical market, a negative 12.07 for the year versus a negative 21.32, and ranked 24th. And if you look at the 3 year, the 5 year, the 10 year, and since inception, they've exceeded their benchmark over our time periods measured. The portfolio's exclusion of stocks with lower profitability and high relative prices and those with high asset growth drove out performance in the fourth quarter. Additionally, the portfolio's exclusion of REITs benefit relative performance in the fourth quarter. Next on the page is Developed International. You've got Fidelity and Causeway. Fidelity represents your international growth manager on the developed side. As you can see here in the fourth quarter, they ranked very well in the top quartile at 18.22 versus 15.05. And over the past year, albeit they're below the Fidelity Custom benchmark, they did better than the average manager in that sector, ranking 18th. If you look at the 3 year, the 5 year, the 10 year, and since inception, they've exceeded the custom benchmark but had more difficulty versus other developed international growth managers. Causeway represents your and how they outperform this time was from a sector and country perspective. They outperform in 10 out of the 11 sectors was rationale for their performance in the fourth quarter of the year. Causeway, as I mentioned, is your international development value manager. As you can see here, great performance in the quarter, 21.42, ranking 13 versus 19.64. Protected on the downside over the past year, negative 6.99 versus negative 13.59. As you can see here on a long-term basis, some mixed performance. 3 years outperform, 3 years outperform, 5 years slightly under, 10 years, and since inception they're above, and right around median since inception, but they have done a good job for you on a long-term basis. And you've got a nice mix here with a large cap. A international developed growth and international developed value. So there's value neutrality, which smooths out the returns of your segment over time. Next page. We're going to the emerging markets equity. You've got DFA and Invesco here. As you can see here in the quarter, the emerging markets added significant value with a return of 10.83 for the quarter and ranked 41st. Over the past year, albeit negative relative basis, they outperformed with a negative 19.07 versus negative 20. If you look at the long-term numbers, the 3-year number not as strong, but the 5-year number on a relative basis, 10-year number on a relative basis, 10-year number is strong, and since inception, right around the index, just slightly off. But if you look down at these individual managers, you can see here DFA, representing more of a value tilt, had a return of 10.39 for the quarter, up since the MSCI Emerging Market Index, which is currently 9.7 and ranked 48. As you can see here, for the 1 year, they about did better than like negative 10.32, but if you've been invested in the index, they're at negative 20.09, which puts them in the top quartile and ranked 5th. If you look at the longer term numbers, you can see here the index has been negative or just slightly positive, and DFA has exceeded that MSCI Emerging Markets Index over time. Invesco, this quarter did rebound. As you can see here, they had a return of 11.32 versus 9.70 and ranked 36. They've had a much more challenged performance over time. As you can see, they've underperformed the 1-year number, the 3-year number, 5 years slightly above, and the since inception number right around there. So we'll keep an eye on that. But collectively, that segment has done okay. And then you got Exponence, which you've had there here for now a couple years as of December 31st. They have added value in the global segment with a return of 11.4 compared to MSCI World at 9.77. And since inception, they've added value 4.88 versus 4.06 in both time periods. In the 1 year, the quarter, they're above median, and they're right around median for the since inception period when they came on in September of 2020. And that rounds out the equity portion of your fund. Any questions about domestic, international, emerging markets equity before we move over to fixed income? Okay, if not, so you can go to the next page. Okay, total fixed income. As you can see here, albeit we had nice positive or relative, well, they're positive, but we had stronger relative performance in the equity as a whole than in fixed income. As you can see here, the total fixed income, which encompasses both your core as well as your opportunistic, you can see here the return for the quarter was 2.68 versus the custom benchmark of 4.71 for the quarter. If you look down the page, you'll see here Manulife and Ernest Partners both did not meet the index in the fourth quarter of the year. Manulife 1.53 versus 1.87. Ernest Partners 1.32 versus 1.87. This brought both of those managers in a ranking in their peer universe in the bottom quartile. Over the 1 year period, Manulife slightly underperformed the Bloomberg aggregate and ranked 76. Ernest Partners, a different story. It was negative, but on a relative basis, it was better than Bloomberg aggregate at negative 12.63 versus negative 13.01, and brought them a rank of 33rd. On a long-term basis, you see mixed performance, albeit they have outperformed the market index in those periods of exception of Manulife, not, and since their inception, no. But on a relative basis, Manulife has done better versus other managers like them since inception, and Ernest Partners is right at median in the core fixed income segment. If you look further down the page in the opportunistic segment of the fund, your active managers did not really deliver in this quarter. You see Loomis 2.19, ranking 88. The TIPS is an index index, and that's just basically what it replicated the TIPS index, which was in line. The Neuberger Berman opportunistic fixed income underperformed 3.7 versus 4.55. Lazard emerging market debt 5.54 versus 8.71. The one manager, which is a diversifier, actually that outperformed and ranked well was Exponent, 3.09 versus 1.87. If you look at the 1 year numbers, you see the same pattern. Again, with not really good performance and opportunistic, but in this particular period, Exponents did not do as well as the Bloomberg aggregate. But that's a very different kind of portfolio, which we're going to more in-depth discussion. We want to have education sessions so you guys can understand. But the opportunistic fixed income, they go where they see value, but it's been a really difficult market for fixed income managers with the rising interest rates and inflation over the past year. Next segment, next page is the global, global asset allocation segment. As you remember, we have only one manager here now, which is the PIMCO All Asset Fund. And as you can see here, just slightly below their custom benchmark, ranked well in the universe, 7.51 versus 7.82 with a 29th ranking. Over the 1 year period, albeit negative, they could protect on the downside with a relative return of negative 10.76 versus a negative 11.03 and ranked 40th versus their peer group. If you look at the longer term numbers, they have been strong versus their benchmark, not as strong in longer term periods versus their peers. Now, the next segment, hedge fund. I know there's a shocker here. As you can see here, the White Box portfolio and the Grosvenor portfolio were very close, or Grosvenor was very close to the hedge fund composite. White Box actually exceeded their index. Intrust only has Korean bonds. And the reason this number is so negative, they had a huge write-down that was reflected. That's all that's left in that portfolio. It's winding down and had a huge write-down in Caribbean bonds. And that's why you see that significantly negative number for Intrust Capital Diversified. So that's why that number looks that way. But that particular segment had a return of a negative 0.99 versus the benchmark of 1.74. If you look down at the other managers that actually still really managing, the White Box Fund has done very well over the past year and did a positive 8.10 versus a negative return for the multi-strategy index of a negative 0.73. Grosvenor Protected with a negative 4.76 versus a negative 5.30. If you look at the since inception numbers for White Box and for Grosvenor, though, what's important here is they've added value since we hired them. 6.34 for White Box versus 3.56, and Grosvenor 6.09 versus 3.88 for their benchmark. Next page. And this is the last section. We don't have all of the returns for the real estate and some of the private sectors, but we do have them for the UBS Trumbull, UBS Property Fund and the UBS Trumbull Property Income Fund. As you can see here, the UBS Trumbull Property Fund did not meet its benchmark, had a negative 5.41 versus negative 5.17 for the NCREIF Odyssey, ranking 57. And over the past year, the return is not as strong, but positive for the fund of 5.69 versus 6.55. As you know, we have put in a redemption request for the UBS Trumbull Property Fund. And so we will be slowly getting dollars back on that particular fund. We did not do it for the UBS Trumbull Property Income Fund. On a relative basis for the quarter, that fund returned a negative 2.83 and ranked 19th over the past year. Also difficult market for fixed income, 4.49 versus 6.55. For those returns, the bulk of the underperformance in both of them was not the income component. Actually, that was positive for both of them. For the property fund, the income component was a return of 0.81 but the appreciation was a negative 6.02. For the property income fund, income was 0.88 and appreciation negative 3.5. So, and both of them have heavy weighting in apartments, with the property fund at 40% in apartments and the property income fund at 69% in apartments. So that rounds out the performance of the different parts of the fund. So if you could go all the way to the back of the report. Before we move, is there any questions or comments with respect to the performance before we go to the watch list? Let's see, go back. Okay, so one more. There we go. Okay. On this page, compared to the last time you saw this page, the changes that you'll see here is, okay, Impact, of course, is gone now. We've already talked about TCW, which is the same as it was last time. What is new on this page is Fidelity, who was qualifying for watch in the last report. As you can see here, only has one red box, which was the 2-year return versus the index. So they are not qualified for watch here on this report. As you can see here, Invesco State, it was on watch the last time. They remain on watch. If you go to further down the page, the other thing, other manager that was not on watch the last time but does qualify for watch this time is the Loomis Sales Strategic Alpha Trust. As you can see here, they fail in 2 of the categories, so they now qualify for watch as outlined in the investment policy document. And that rounds out my portion of the performance reporting. Any questions before I turn it back over to Jeff? And Jeff, please feel free, if I've missed something, to add in.
No, that's great. I guess the only thing that maybe I know we had it as an agenda item, and maybe this is probably the best time to talk about it, would be right now since we're on this page, is Exponents, which we have quantitatively here on watch because they're meeting these rolling 2-year metrics, but also just to remind everyone that we've also had Exponents on watch because they had a portfolio manager change. And then there's also been some discussions with the manager. And I know most of the group was in on a special meeting with them when they talked about what they were thinking about doing with the portfolio. So we've subsequently had additional conversations with them to go through a few things. And the first was we were just trying to get a little bit more history since the inception of this manager, because we know there's been a couple of iterations of this portfolio, that it started out as NCM, and then there was a couple of mergers and acquisitions that went on to ultimately get them to where they are today, Exponents. But I guess what really didn't change was that the original portfolio manager going back to NCM was the same. It was Randy, and that's who retired. And that's really our main rationale for watch, because we do have a significant team member change to keep an eye on it. But then when they started talking about things they might want to do to adjust the portfolio, that's really where we wanted to come in and say, well, I think we warrant even further watch because of what they're saying. Now, ultimately, I think that and Gwilda, just step in and correct me if I'm conveying this wrong, but again, our understanding is that they're not really looking to make wholesale changes with the portfolio. It's going to be more on the margin. But again, what we wanted to figure out from history is when you originally hired them, did the portfolio significantly change? And again, it really didn't. Bottom line is it's really the same portfolio it was from inception, and the same strategy. But where we were a little confused is we went back and took a look at the original presentation from NCM, and it looked like what they were marketing was a core product, but ultimately it really wasn't, and it hasn't been. So I think there was maybe a a little bit of haziness in communication going on back then. But nonetheless, the strategy, it is designed to operate differently than a core manager. So it's going to have more volatility, but it's also going to have more yield, and it's going to really act differently from the other fixed income managers in the portfolio. So again, that's something, if you recall, when we did our overall program review and we sort of recategorized all of the different risk buckets in the portfolio, that we took that one and said, well, it's really not core. It does something different. Let's size it differently. Let's position it differently. And so that's what we have done. And I think ultimately what we've conveyed to the manager, again, we said, well, if your intention is that you want to turn this into a core portfolio, that's probably not as attractive for us, because the way this has been positioned and what we've recommended to the committee and has been approved is for this to be an opportunistic strategy that's a diversifier and acts differently from core managers. And if the intention is to move it to core, then we have to go back to the drawing board and reevaluate versus your other core managers, Manulife and Ernest, who have both done a good job, and we're sort of where we want to be with core managers. So I think they understood that, and so I think they know where we stand, and what our recommendation would be here is to really keep operating that as a more opportunistic strategy. So that's sort of where we left it. We don't expect there would be wholesale changes, but from the standpoint of watch list, again, not only from a quantitative basis, because some of their recent performance has been a bit more volatile, but again, because of the portfolio manager change and some of the things that they might be looking to adjust on the margins, we want to give them some time to make sure that does play out, and that ultimately they are set to be a good risk-adjusted return manager and a good diversifier for the fixed income portfolio. So again, no change in status there. We still have them on watch, and we'll keep them on watch from a quantitative, and also a qualitative basis, just from an organizational change basis. And but as that sort of goes, the one piece that we really that haven't addressed as we went through our program review and did some rebalancing and restructuring, that's the one piece that we've held off on, and we haven't taken them up to their target level yet. And we'll still maintain that recommendation of let's not add capital to them at this point until we start to get past some of these thoughts and where we are on the watch list. Any questions on Exponence?
No questions on Exponence. We'll have to mention somebody who's been on, like, this is the second or third time that they've been on the watch list. Who was that? Or they've been continuously on the watch list.
I don't know who that is, Al.
One that has been on the watch list, I think,
But you know, I
has
know.
been, I think it was Newberger
Who was it?
Berman.
Okay.
Newberger Berman has been on the watch list. And the Invesco Emerging Markets. Those are the same ones that were on the last time.
Thank you.
Mm-hmm.
Yeah, and I would say from just, again, the standpoint of a recommendation at that point for those two, I think what we can, at least from what we've seen, that a lot of these factors that are causing them to be on this quantitative watch, which are these rolling 2-year numbers, those have been heavily influenced by the magnitude of some of the recent underperformance. But if we start to go out into time and look at what those managers have done since inception, and their performance has been, over a longer term, a little bit more consistent. It's just they are hitting these short-term measures. So again, when they hit these certain screens, we have to flag them and say quantitative watch. But from the standpoint of are there other things that cause us concern on those two managers? We're not there at this point. So there haven't been any major organizational changes or strategy structure changes, anything that would say, hey, let's look to replace these managers. We just think it's been kind of a crazy and a hard to tackle global environment for those types of strategies. And as we'll jump over to the January returns, you can see where these have been, and we are seeing some improvements in some of these managers as well. So.
Thank you. And that's why, and then X1 is we're just waiting. We're going to watch them just because of the changes in management, and we're just going to make sure we keep a close eye on them.
Correct. As well as their recent performance has also been a little bit challenging. And again, a lot of that just having to do with this interest rate environment that's hurt a lot of fixed income managers. And so with a strategy like theirs that's very focused on that yield and that yield portion that can be susceptible to short-term interest rates and what the Fed is doing, they're a little bit more amplified on that performance.
Thank you, sir.
Great. So if well, is that everything we want to cover on the quarterly?
Oh, yeah.
Okay. Sue, why don't we jump over to the January flash? Okay, you want to flip to the first page. And this is just, and I want to be mindful of our time because I know we have, I think we still want to talk about the schedule. So I want to leave us a few minutes to do that. So I'll go through this pretty briefly, but again, you can see just for the month and those on the left set of tables and all the way to the left, that's the January returns. And you can see starting at the top, large cap stocks, a great month, over 6%, the mid caps, 8%, and the small cap, which is the Russell 2000, almost 10%. So you can see by and large a good market, and one of these where a lot of market participants saw some favorable news, a little bit better number on the inflation front, some language from the Fed telling us that maybe they could be closer to slowing down those rate hikes, and everybody taking a look at how oversold a lot of stocks have become and continuing to come in and be buyers. So that really prompted some nice returns. Same with the fixed income, that's the middle section, and you can see the US aggregate. So that's all of the investment grade stocks, a lot of the different investment grade segments of the market. That's really the full market, up over 3%. So again, when we see these environments where we think we're not going to see interest rates rising as much, that's gonna do very well for a lot of fixed income segments. The corporates were higher than the total market. So again, that's just if companies are doing well and have good earnings, which we've seen a lot of good earnings coming out from companies over the quarters, and also telling us that they have nice balance sheets. And when I say something like a nice balance sheet, it means they're not taking on too much debt relative to other ways that they raise capital and operate in the markets, then those are also good for those corporate issues, and also the high yield securities as well. And then you can even see outside of the US on the global basis, very good numbers for fixed income as well. So does a good start to the year, and you can see where that kind of shakes out. If you go to that next set of boxes to the right, those are the different equity style buckets, and you can see, at least in the large cap space, that deviation that we've seen over the past couple of years now, where we've seen through COVID, where we had the growth stocks leading quite a bit, and then over the past year that reversed. We saw a lot of those growth stocks selling off and value doing much better, but now we're sort of back, at least for a 1 month period, to that deviation where growth has been a leader again, at least amongst the large caps. Mid cap stocks, fairly similar returns across all of the style blends. And then down at the bottom again, also very similar returns across each of the categories. So really it's in the large cap where we saw that differentiator. But again, the small and mids outperforming the large for the most part, and that's just more of the risk-taking tone coming back to the market for the short term. So Sue, why don't we jump forward 1 page? And you saw this chart as of the end of the quarter as Gwilda went through it, and a couple of things we'll point out on this page. So if you recall, for the past couple of quarters, and Gwilda pointed it out, where we had the hedge fund had that triangle that was being flagged red because it was a little bit higher than its range. Well, that money that was put in for a redemption to bring us into range, that has now come back as of the end of January. So that brings us within range. And as Gwilda mentioned, again, that money that did come back from Grosvenor, is our recommendation was to push that back over to the core managers, in particular Ernest, because they've been a bit underweight. So that brings that core equity allocation as of next month's report should be getting closer to that middle target line. So again, all of the triangles that we see for each of those categories are now within the gray tolerable ranges, and a lot of them getting closer to those middle lines. And certainly the equity markets and the fixed income markets performance that we saw that's been very favorable also helps move those lines back into place. So when we have really strong equity market returns, it organically moves those triangles for us. But again, part of the process that we work with Sue on is making sure that we're following the policy, and when we come up with a plan of the next several months worth of cash flows and how we're rebalancing, that we're always doing that to keep all of these triangles within those gray ranges, and more importantly, trying to move them as close as possible, within the confines of what the markets are doing, closer to those vertical black lines, which are the targets. So again, we're in pretty good shape here relative to policy. Next page, Sue. Okay, so translating those nice numbers we saw in the first page with the market overview, a lot of that carried over nicely to the performance of the plan. So you can see for the month at 4.3%, so a little bit behind the benchmark for the period. So we'll see a couple of spots where we were off. And again, I'll certainly focus and talk about diversification and things that we're seeing out there, because if you saw again in the quarterly report, something that was really driving that large cap equity performance was the Lomax return. So they had an excellent return, and their longer term numbers continued to be favorable. But this was a quarter where they didn't do as well, so they're behind the benchmark. But again, think of these offsets. So number one, we indexed a portion of the growth, so we don't have that Mellon piece yet. It doesn't have a full period of performance. As we go through the next couple of months, that'll start to populate, but that performance will be right on that line below it, the Russell 1000 growth, because again, this is not an active manager. All they're doing is at a very low cost replicating that index. So think about it. If we had the Mellon DB SL large cap growth stock index fund going back 10 years, we would be at 14.5%. So that's the return we should expect from that. So again, that's just that strategy will match the benchmark. But more importantly, again, of just talking about offsets and thinking in a period where you have something like Lomax that is off the benchmark, well, now you have TCW, which has had a couple of quarters of struggles, now getting it back in the month of January. So again, seeing that sort of diversification within the portfolio play out and creating a nice offset. So flip to the next page, Sue. And So again, let's think in contrast to what we saw in the quarter. So on an absolute basis, that total small and large cap, or sorry, small, mid, micro cap area, a nice absolute return, 8%, but it is behind the benchmark a bit. So and again, a little bit of reversal of a couple of things that we've seen. So Westfield not too far off of their benchmark, just over 9%. Systematic will be the biggest underperformer for the month, 7.3 relative to 9.5 for their index, and then DFA underperforming by about 1%. So again, just think about when we looked at that chart with some of those names that had really big swings for the quarter of the 50s to 100%, whether it was positive or negative. Well, we've continued to see a lot of those types of movements in January and February as well. So some of these things that, again, these are very well diversified mid and small cap managers that we have, and so we even when they are missing in a month like January, it's not huge, and it's not creating a big miss or an impact on the total portfolio. So again, a structure that continues to work very well, and we continue to see that in the long-term numbers, and in particular, as of this report, the January, that 10-year number at double-digit returns for a component relative to something that was just south of double digits. So that's a very good construction for that portfolio. The international portfolio in total, almost 10%, and that's almost 2 percentage points ahead of the benchmark. You can see Fidelity was a little bit ahead of the benchmark, and then Causeway was nicely ahead of the benchmark at, again, a double-digit return for a 1-month period versus their index, which was at 8%. In the emerging markets, a little bit ahead of the benchmark, but again, that nice solid absolute return of over 8%. So again, a nice complement of a couple of managers. DFA in the value space, a little bit behind their benchmark, but then Invesco creating a nice offset and well ahead of their benchmark, so almost 10% versus an 8% return. Jump forward one, Sue. On the global equities, again, a nice month in aggregate for all of those managers at just close to 7%, so nearly a percent ahead of the total benchmark. But you can see where that nice nominal returns from each of the managers within that subcomponent, but that relative outperformance driven by one manager, and that was a great month for them, 14% versus the 7 on the benchmark, and the others in that 6% range. So again, really nice nominal returns, a good mix of managers that are doing very different things and complementing and offsetting in these crazy volatile markets. Next page, Sue. Okay, and the fixed income component. So again, a nice solid nominal return as a group all the way at the top for the month at about a 3.2% return, a bit ahead of the total benchmark. And you can see where the core managers were. And I apologize for this. Well, our monthly report didn't get restructured to the same manner our quarterly will. So we'll have to get this adjusted. But here we still have exponents in with the core group. So we'll get all that recategorized, but it doesn't really change the top line numbers of how things worked out. But again, good month for exponents. So nice to see them getting some of that value back relative to the benchmark. So they're they are the strongest manager for the month across the categories here. So Manulife also a nice return, 3.5%. Ernest not too far off that as well. So as a group, good. The Loomis, and again, I know we talked about the Loomis and the Neuberger. So we like to see months like this where they have a solid nominal return, and it's also outperforming the benchmark. And you can see that 1-year number, and that's really the hole that they're trying to dig out of. So a negative return in the wake of a benchmark there. And again, we'll have to reconfigure that benchmark because we have changed that as well. So relative to what we really should be focusing on, how they're performing in the markets they're in, that relative number is going to look a little bit better The tips solid for the month, but again, not as good as the other areas of fixed income. So that comes back to this whole market dynamic of if we think inflation starting to come in and is not going to be as high on a go forward basis, then those tips returns won't be as good as other segments of the market. But again, we're happy with a return that's almost 2% in that category. And then you can see that Neuberger return, again, similar to what we talked about with Loomis. Nice solid return for the month. Still have some way to go to build back what they have been down for the past year. But again, we think they're well positioned, and with where interest rates are and their total setup, that they are poised to recapture that value. And flip forward one more, Sue. And so with PIMCO, again, a nice solid return. And remember, they are really a mix of a lot of the things that we've already talked about. So the equities and the fixed income and these different segments that have all done very well. So to see them participate and have a nice return that's over 5% in these markets, that's good. And that'll also put them comfortably ahead of their benchmark for the period. And the hedge funds, Gwilda did talk about Entrust and some of the things going on there. And the important thing to also talk about with something like that Entrust position is if you look, it's just south of now $200,000 on a percentage basis. So even when you see a large swing for that 1 year and 3 year that are big negative returns, it's a big negative return on a very small piece of the overall system. So it really doesn't move the overall performance of that top line total system return that we see. So again, we're just sort of leaving it to them to go out and see if they can find a deal for that last piece of debt in the portfolio, and hopefully finally fully liquidate it and get us some sort of positive return on the outset there. And then White Box, a slightly positive return for the month, and same with Grosvenor. So they're both of them are pretty much in line below the benchmarks. But again, think about this total hedge fund component at about 6% of the portfolio. So designed to be a nice diversifier. And as we saw in those more volatile markets, those were the assets that were doing well when a lot of the equity and fixed income wasn't. So again, really longer term doing what it's been designed to do, give us a nice solid absolute return, but also be a good diversifier and downside risk protector in these more volatile environments. And I think on the last couple of pages, probably not going to have a whole lot of data here. So the real estate returns we're only going to get on a quarterly basis. So put little credence in those zeros. They're not very meaningful there. We don't have full returns yet. So, but otherwise, really good month, and good continuation of what Gwilda showed us for the quarter, and we saw what that has done for the longer term returns of the system. Continues to move us in the right direction and keep us on target relative to that policy, relative to peers, and also to that long-term actuarial return assumption that the actuaries use for valuing the liabilities of this plan. So all of that has been good.
That translates to $8 million.
Gwilda, you cut out there. Can you repeat that?
No, I said that. Oh my God. Okay. I said that the return translated into about $28.6 million in increase in market value from December to January. Can you hear me?
You're very muffled. You're very muffled.
Okay, I just got a new speaker too. I don't know why. Well, Jeff, maybe you should do the calendar. My speaker's not active.
Okay, I'm trying to read lips. I think she said, let's go through the calendar. So
Yeah, the calendar. I don't know what's going on with my speaker.
I think Gwilda is having technical difficulties with the microphone. So yes, unless there's no other questions on the monthly, we'll go through our last item here, which is the calendar. Okay, so this is what we have sketched out for the rest of the year, and again, this is certainly subject to change if there's other things that do come up along the way. But a couple of the things that we certainly wanted to point out in this are some of the educational items that we had mapped out, and a lot of that's going to be due to activity that needs to occur over the coming year and also the following year, just based on the private equity and private debt pacing study that we shared. And so we know, and it's Gwelda talked about earlier, by policy that private debt is really an area of focus because we want to get that closer to its policy. So you see for March, we have a couple things lined up. The private debt education, which are planned, and I know we possibly have a scheduling issue, so Sue, we might have to talk offline about that. But because our individual that heads up our private debt and makes these recommendations potentially has a conflict, so we'll have to talk about that. But for all intent and purposes, we want to get that portion done as soon as possible in the year, because we want to get these fundings underway. And in particular, we have one recommendation, which it's a fund, Strategic Value Capital Partners, and they're coming out with a new private debt product. So that's the one we want to go through and give everybody a chance to take a look at, ask questions, and have some education, not only on how private debt is structured and works in general, but also how that particular investment can be value additive for the portfolio. So also in March, we have a custodian review, and I'll let Sue jump in if she wants to add any additional detail on this. But certainly it's been a while that the system has been with US Bank, and it's always good form to periodically, as you've done with your other service providers, go out and evaluate and certainly see if the services are on par with other peers out there, and to make sure that the pricing that you're getting and everything else along with your custodial services is in line, and certainly see what else is out there. So that's something that we're in the process of, and I think as part of that, you can see for the following month, we want to do some education again, because I know we always throw terms around and we talk about it quite a bit, of a custodian, and we're going to do a custodian RFP, and sometimes it's a good idea to refresh exactly what a group like US Bank does, and what they're actually bringing to the table, and what we're looking at if we're going to do a request for proposal. So we are going to do some education on that in April, just to go through that. So that'll kind of help us in the process, and as we go through the year and get together the RFP to ultimately put out there into the market. So, and again, for April, the fund performance as normal, manager structure. So that might not be just given a lot of the heavy lifting that we did up front with our manager and structure review, unless there's anything major going on in the markets with certain strategies or managers that could be a shorter discussion, and that will also dovetail into any rebalancing that might need to be done in the plan. So again, that's something that we've designed our reporting and structure. And when you take a look at the chart that we show you every month and in the quarterly report that has those bars and where things are relative to the bars, it makes that discussion a lot easier for us. And it's a really codified process that says, at the end of the day, these are our objectives. These are the little lines and where we need those triangles to be. And we're going to work around the portfolio and make the recommendations and moves that keep us there. So going on to May, that's the first quarter report for 2023 in the watch list. And again, reviewing any items that might be on watch or any changes that might be necessary. Sue, if you want to scroll down to June. So we had the review of fund performance, and so that will be monthly. We also now have, after we've gone through that process of going through the private debt education and also the custody education, we'll now be closer to have actually a couple of deliverables and recommendations on both of those fronts for that period. July looks like we have slated for no meeting. August, we did talk about having a special meeting just due to the fact if we're not going to be meeting in July, and we do need to think about having other custodians or even U.S. Bank or whoever might be shortlisted in that process to come in for interviews. We would want to do that in a special meeting because that can be extensive. Because if we're trying to put that into our regular meeting, we're probably just not going to have the time for it. So here we're looking for a special meeting for that. Going on to August, second quarter 2023 reports. Again, the monthly review, discussion of the custody interviews and recommendations based on what transpires from the special meeting. Going into September, again, the monthly review, and now we move into the private equity portion of what we took a look at in the pacing study. So again, there are placements that should occur to keep us on target with what we outlined in our pacing study. And so again, we want to outline some private equity education and also have a potential fund in line for a recommendation. And so we'll start that process from education to also looking at a specific potential investment. October, again, monthly performance. Education, where we have marked tentative, so we'll sort of see where we are with some of these other areas and items, but certainly if we have time to fit in an additional educational session, we can look towards that. So we can look at things from a fiduciary education, or if there's specific things that anybody wants to focus on, maybe what's going on in the stock market, or what is a stock, or what's going on with the bonds. I know one thing that we did talk about, which might make sense for then, but we can hold off because it's a while off, was just having exponents, and depending on where they're at, come in and re-familiarize everybody with that portfolio, since it is sort of a different structure from what we're all used to in looking at these core managers. So that's a potential to think about for that October education. November, again, monthly performance review, and then the third quarter performance as well, and the watch list. And then moving into December, again, the monthly performance for November, and then looking at the next pacing study for private assets. So again, if you recall from the last pacing study that we did, that's always a moving target, and it's always hard to tell from each given year how much money we might be getting back from our current managers, and then what that does to our target, how quickly the new managers that we identify are calling capital and putting that to work. So again, it always makes sense to be periodically looking at this pacing to determine how many new things we need to be thinking about for the following year. So just trying to stay ahead of the curve. Questions, comments? Seems like a lot, but we've got a whole year, so to tackle it, and we try to keep it in bite-sized pieces here.
Yeah, I appreciate you all working on the schedule, and, gives us something, that we know each month kind of, and like you said, we can revisit it as well.
Great. Unless there's other questions, I believe that's all we have. Is correct, Rolla?
I just have one question on the dates. I need for Albert or Bobby to answer this question. When is Parents Conference in April? Is this a conflict?
It's in March.
Okay, never mind.
Okay.
Okay.
It is in March. March 16th, Navy
Right.
parent teacher. Maybe it's that week because that's the Thursday before the last. So it may be conflict with it may come. It doesn't conflict with us at my school, but others it may conflict with.
And it sounds like, Jeff, we might have to look at a different date perhaps anyway, but we'll talk about that. If was it March that you thought you might have a conflict with your?
Yeah, so,
yeah,
yes, I know Gwelda might, she's having microphone problems here, but Gwelda and I will we're gonna need to get offline just because I know internally there was a question of whether it was, we could still make it happen. So we'll have to confirm with our research group and if it's still viable, but we might have to possibly play that one by ear. But again, our overall discussion is if we have to move that, we really wouldn't want to move it past April. So we might have to jockey maybe the April and March items because with the private debt, we just want to make sure that we have enough time for the education and for everybody to understand and at least to get the committee sign off, because we know we have to have committee sign off, then it has to go full board, and then for a final investment document review and legal. And so there's a lot of I's that need to be dotted and T's crossed before an investment is made. So that's why we wanted to make sure we're earlier in the process than not. So
I'm looking at the calendar, and the Parents Teacher Conference is March 13 to the 17th. The week of the 13th to 17th is Parent Teacher Conference.
Yes, that's what we decided. They said they might have a conflict anyway, and I guess it's depending on the trustees if we actually have. It could be a conflict. If they have a conflict, they have to change it anyway, but no later than April. And they'll get back to us offline once they talk. They'll get back to us, and we'll try to set that up accordingly.
Okay.
Yeah, and as far as, we would not meet, the full board would not meet until April. So if we had to switch those and talk about the private debt in April, it would be at the following meeting, then that, could get approved to get started, any recommendations. So.
All right. Are we done?
That's all we had on our end. So appreciate everyone's time today. So hopefully everyone was pleased with some better numbers. So
Okay.
Yes, I like seeing the positive numbers than the negative.
No doubt.
Well, thank you, Jeff and Gwelda. But I think this is time so we can say I make a motion to close this meeting, this investment meeting on February 16th, 2023.
Second.
We don't need a roll call.
All in favor?
Aye.
Any opposed? Nay. Yeah. Enjoy the weekend, or enjoy your weekend.
Okay.
And the holiday on Monday too.
Right.
Yes.
3-day weekend.
Yes, everybody enjoy the long weekend, and hopefully your weather keeps up. And I think I'm gonna be battling some cold here. So.
All righty.
All right.
Take care, everybody.
Okay, bye everybody.
Good night. Bye-bye.
Good night.
Night.